Hi everyone, welcome to the webinar. I'm Emma Geard. I come from the Ākina Foundation, and for those of you that haven't heard of us before, we are an organisation that is aiming to help build a social enterprise sector in New Zealand. So I'm going to switch to the slides now because it's a little bit awkward just looking at me. So this workshop is on finding funding for your social enterprise, and it's, I guess, quite a broad topic because it comes with everything from finding initial maybe grant funding, seed funding to do your research and development, all the way up to growth capital or long-term banking and working capital. So largely today we'll focus on the early stages of funding because that's what people tend to need at the moment. But yeah, do fire through any questions if you have them. People have started using the chat function, so I'll be checking that as we go through. So yeah, do fire up any questions if you have them. Ākina's purpose is to create a sustainable and prosperous and inclusive New Zealand. And we want to do that through the vehicle of social enterprise. We see that as something that's taking off around the world and is a great way to scale some really awesome solutions. So our role in the ecosystem is providing various types of support. So we do things all the way from these kind of workshops, giving people an introduction to various aspects of building a social enterprise, all the way through to kind of one-on-one support, either building your business model or helping them raise investment. So yeah, keep in touch with us if you do need some support, and I'll give you more information about that at the end. So just so you know, these slides will be available. I'll send them out afterwards along with a feedback form. It would be great if you could fill that out to help us improve what we do. And I'll send out the recording of this webinar as well, so you can rewatch it if you like. So social enterprise, it's a really hard one to define. And the way we look at it at Ākina is that it's more of an activity. So it's definitely not a legal form for those of you that tuned into the last webinar. But it is a kind of organisation that's purpose-led. So it exists to create some kind of social or environmental impact. And it does that through trading and commercial mechanisms because that's a way that we can scale the impact. So it's about having a business that is a means to creating social impact rather than the business being an end in itself. So some people that have taken the poll have said that they want to look at organizations that are social enterprise friendly. So I will give you a few examples of those, but I think what is really important to get across in the early stages is the kind of foundations of why you're doing this, what are the true benefits of being a social enterprise, and what are your overall options. So I'll be going through why be a social enterprise, how a social enterprise funded. So I'll go through kind of at a very high level, I'll go through the whole path of getting initial seed funding all the way through to sustaining yourself by your own revenue. We'll have a look at the different options and when they become appropriate, and then we'll spend most of our time at the end looking at where do I start, where can I find funding. So the first is why be a social enterprise, and I like to cover this because there is a common misconception that it's easier to get funding if you are a social enterprise. I haven't realized that I've been on the screen this whole time, so I'm just going to get rid of that. Yeah, so, I mean, the reality is that there are more sources of funding if you're a social enterprise, but more work goes into getting those sources of funding. So, in some ways it's easier and in some ways it's not. So in terms of funding social services, the traditional model is this grant funding life cycle. You start off by generating your idea, you find the types of funding, or the organizations that fund the kind of impact you're trying to create. And then you develop your proposal, submit it, and then you get the award, you deliver on what you've promised, and then you go through this process again and again. And this has been really useful. You know, the traditional grant funding or philanthropic and charities models, there is nothing wrong with them. They create a whole bunch of really useful outcomes. And often when you're doing some kind of social activity, this will be the right option for you. Social enterprise is something that we're excited about because it's something additional. What we do know about the traditional funding cycle and traditional charitable model is that it's not sufficient. It's doing really good stuff, but it's not going to solve all of the problems that we're facing in the world that are growing and growing. So social enterprise has the potential of scale, but it also isn't the right solution for every intervention. So it's something additional. So just keep in mind that this actually might be the right path for you. So when we talk about social enterprise, I've already mentioned scale. There are a couple of really good reasons to go down the social enterprise route. And the first one is, have you built something that can potentially scale to the size of the problem that you are trying to solve? And often scale, because with grant funding, there's a limited pool. There's a lot of money going into philanthropy, but as I said, it doesn't match the problems that we have in the world. So if you can trade in a way that helps you to scale your operations, you're more likely to find scale if your social enterprise is successful than if you're growing through grant funding, because finding really large chunks to grow your operations of grant funding can be really difficult. The second is autonomy. So with grant funding, you often find that organizations that provide the grant funding, they are also social organizations. So they exist with an idea of the impact that they're trying to create in the world, and then they give money to people that are aligned with the impact that they're trying to create. So if you are an organization that doesn't necessarily align with the funders, if you're trying to do something new or approach a problem in a different way, it can be really hard to find funding. And sometimes you just end up going to the person that has money and fitting in with their idea of how the impact should be created. So yeah, if you're trying to do something new and different, social enterprise can be really useful in that sense. And finally, there's innovation. And with traditional grant funding, because there is a limited pool and it's really competitive, people don't tend to want to fund things that are really out there or really unproven, which means it can be difficult to push forward some new and innovative ideas because they are more risky. So social enterprise can be a really good idea, a good way of getting innovative ideas off the ground. So to do that, what we need is trade and investment, and because those are all things that we see in the commercial world. There are there's an underlying sense that sometimes that social issues should not be dealt with through commercial means. And when we get to that stage, we have to consider, is commerce inherently evil? So if we look at trade and investment in particular, trade is the exchange of values. You provide someone with a product or service and they pay you in return. And in a lot of cases, people have gotten really used to, when they're doing good stuff, they get things for free. And that's really, there's nothing wrong with that, but it's not quite as sustainable as, the exchange of value. People paying for the services that they're receiving. And then investment's exactly the same. So even if you're buying shares in a social enterprise, you're putting your money at risk. And, you know, lots of grant funders do that for free, and they don't expect anything in return except social outcomes. But if you are moving to investment rather than grant funding, you can access larger sums and from a larger pool of people. So again, it's a weighing up exercise, but commerce is not inherently evil. And if you tuned into the last session, we talked about governance and the many ways that you can influence the direction that an organization takes. And yeah, culture and strategy have a huge role in that. So just because you take a commercial model doesn't mean that you automatically start focusing purely on maximizing your profits. So the price of sustainability, yeah, we just talked about the benefits, but when it comes to building a social enterprise, it's really important to realize that you are building a business. So when it comes to funding, the whole approach we take around funding social enterprise is often more analogous to raising money for a company or a business than it is to raising money for a charity. And so you need to understand what it means to build a business and what will be expected of you. That means that it's actually more work, because on the one hand, you're doing a whole bunch of stuff around the social outcomes and the problem that you're trying to solve socially. And then you need to be doing the same thing on the commercial side, because if you're using trade and investment to scale your solution, then you need to be successful at the trade side as well as the impact side. And the third thing is, it is unfamiliar to funders. So I will cover off some of the organizations that are keen to support social enterprise. But the price of long-term sustainability is that often in these really early stages, it's quite a struggle. And I think, you know, for any social organization, it's a struggle to start off with. It's really competitive. And so that doesn't change if you're a social enterprise, unfortunately. How? So now we're going to look at how funding of social enterprise works. And as I said, it's actually more analogous to finding funding for a business than it is to getting funding for a charity. So the first thing to think about is, what are you pitching to the people who you want funding from, whether that's a charitable organization or a government grant program, or when it comes down to it in the long term, it might be potential shareholders or a bank. You need to know, if you are a social enterprise, then what you are pitching to them is self-sustainability. So the idea is that eventually you will be funded by your revenue without needing to be subsidized. And that doesn't mean you don't take a whole bunch of subsidy to get there, but the idea is that eventually that's where you're heading. And if you're pitching that to them, they will want to know how you intend to achieve that. And so I'll just mention also that social enterprise activity can happen in not-for-profits as a different revenue stream. And in that case, what we're talking about is not the organization as a whole being self-sustaining, but that activity, what you want in the end is for the activity to be making more money than it costs to run. So that might seem obvious, but people do forget that when they're looking for that initial stage of funding, because people aren't going to fund necessarily the social outcomes that you're achieving. If you are going in as a social enterprise, they'll be looking at, in the long term, are you going to be able to keep delivering these social outcomes? So really they're putting their money towards building the business rather than directly into the social outcomes. And that's quite important when you're talking to funders. That needs to be clear, because any uncertainty and confusion yeah, it makes for a less convincing pitch. So you're also looking at your impact strategy. So you need to have a really clear idea of what the impact is that you're trying to make, and how your activities create that impact. And the other thing that's really important with social enterprise is how will you balance the two? And in the legal structures webinar earlier, we looked at different ways of protecting your mission, but especially if you're going to early stage charitable grant funders, they'll want to know that you are somehow protecting the mission, because otherwise it's quite a risk for them to put their money into your organization if you're going to end up not actually creating any social impact and just maximizing profits. And the last one is, why do you need the money? And this comes back to what I said at the beginning, that people aren't funding your social outcomes. They're funding the building of your business. So what is it about this chunk of money that is going to get you closer to the stage where you will be self-sustainable and not require any further subsidizing? So in order to do that, people are going to look at the risk. They're going to be thinking, where does the risk lie in terms of you not achieving this self-sustaining outcomes producing organization that you're promising me? And when we look at that, we have to remember that all businesses are inherently risky, and the different types of funders that you go to will be willing to take different areas of risk. But remembering that most grant funding organizations pay you money so you can directly go and deliver some kind of program that will create some kind of social outcome in the next year or so. They're not used to you saying, well, I'm going to do this now, and it's going to lead to this many outcomes and this much revenue, which leads to me being self-sustaining. And that means that you want to tell a really clear story about how you're going to get from where you are now to self-sustainability. And then once you've got that story, they can assess the risk, thinking about, well, where are the assumptions? Where are the points where I'm like, well, I'm actually not sure that customers are going to buy this, or I'm not sure that customers are going to pay this much. So the first thing they might look at is customer buy-in. How do you know that the product that you've created is something that customers need or will pay for? They'll want to look at competitors. Who else is out there doing the same thing? What's the risk that people are going to go to them rather than to you? Execution and team, probably the biggest. Thinking about who do you have in your team? What skills do you need to pull off the pitch that you're making? And do you need more team members in order to fill all of the skills that are needed? Resource. So if people are giving you money now, will you be self-sustainable by the time you've used that money? If not, where do you think you're going to get the next chunk of money from to keep going along this path? Because again, if they give you some money now and that sustains you for a year, but you can't go any further after that, then that's a really big risk that you're not going to achieve that self-sustainability that you set at the output. And the last one's time. Like, how much time will it take for you to reach sustainability or for the outcomes to be achieved? Because what could happen is in between, any of those other risks could be amplified. More competitors could come into the market. Someone on your team might leave, or customers aren't interested in this anymore because something's completely disrupted the market. So what you want to do is have a plan of how you're going to get from now to self-sustainability. And that means being able to just purely survive off your own revenue, and be really clear on what the risks are about that not happening. Where have you made assumptions? How can you prove that those assumptions are real? And you don't have to have that all figured out, but having a really clear idea of how you're going to eliminate those risks as you go along is quite important. And then on the flip side, the exact same stuff applies in terms of the social outcomes risk. So if you've worked in the not-for-profit space before, you'll know that it's quite advanced in terms of understanding the impact that you're making and even having to report on how well you're doing. So you need to show things like beneficiary buy-in, what other providers are out there. So is your intervention actually needed? Do you have the team to execute on it? Where will you find the resources and time? So it's exactly the same thing on the commercial side and on the social side. You have to have an idea of what you are pitching to people, which hopefully is kind of sustainable social outcomes, and how you'll get there, and understand the risk of you not getting there, because there absolutely will be risk. That's inherent in business and in social interventions. So that's what people will want to assess when they're considering whether to fund your organization. And it might be that if you're going for a charitable grant funder, they'll be more concerned with this slide, the stuff on social outcomes. And if you're going to commercial investors, they might be more concerned with the other side. But if you are planning to be a social enterprise, then these things should be really important to you anyway. So you should understand these things just for the good governance and running of your own business, as well as being able to convince any potential funders that you have a really good business that should be invested in. So not for right now, but I'll send out these slides again, and I think it would be a really useful exercise for anyone here to think about what's the major business risk of me not reaching sustainability, which means I need to make a plan for removing this risk, whether it be acquiring more customers to show that there is customer buy-in, or even just interviewing my potential customer segment to kind of to lessen the risk that nobody's going to buy my product, for example. And then what's my major social outcomes risk? And that might be, well, there's this other provider doing similar stuff. So how am I meeting an unmet need? How do I make sure that I'm either accessing different people or providing a different service so that I'm not just doubling up and I am creating an impact? So you can go through all the risks that are on the previous slides and have a think about how you can get closer to sustainability by gradually removing those risks. So the next is the what, and this is, what are my options? What are the different types of funding that as a social enterprise I can access? And so what we covered in the previous section was, there is extra work. It is a different proposition if you're a social enterprise. But on the flip side, the different types of funding that you can access are more diverse. So there's a much larger pool of funding that if you are successfully building a social enterprise, you can access. You may not need to. So we'll go through all of these, but it may be that you can take on grant funding, and from that grant funding, you can start building up your revenue, and then you can fund yourself purely off your revenue. So you might not need all of these different types, but it's handy to know what's out there. So the first is grant funding. Grant funding tends to be, remember actually that with all of these different types of funding, you're getting money. So that's not really changing. What changes in each situation is what you're promising in return. So in terms of grant funding, what you're promising is social outcomes only. So funders might require you to report on your social outcomes, but like we looked at earlier, they'll want to know that you have a plan and be understanding how their money is getting closer to you delivering on that plan. It might also be, so lots of government grants are focused on economic development. That's still a form of social outcome. But yeah, the thing here is that generally, well, with grants, you are generally not asked to repay the money. You're only asked to provide some kind of social or environmental outcome. The level of risk that funders in the grant space are willing to take varies. And this is because grant funding generally operates within market failure. So grant funders will be looking at how do we solve an issue that the market won't address. And so they're looking at it from quite a different perspective from what investors might look at. So yeah, this really depends on what the organization is trying to achieve and how much risk they're trying to, well, they're willing to take on to get there. And by risk in this situation, I mean that social outcomes risk that we looked at earlier. And the amount, usually with grants, and this is why I said it's really hard to get growth capital if you're purely relying on grants, is because generally grants you'll only get up to about 50K. So there definitely are grants out there that will give you a larger sum of money, but they are few and far between. And as we'll see when we get into investment, you can get much larger sums. It's more likely that you'll get larger sums if you're going for investment. Again, you might not need that. You might just go straight from grant funding to revenue. I know examples of organizations that have done that. And yeah, you may not need to scale quickly. You may be able to grow slowly out of the revenue that you create. So it's all about having a plan and being strategic about how you will reach sustainability. And the last part is funder control. So if we remember that in order to receive money, we need to, it's a value exchange, and we need to promise something to funders in return. In the case of grant funding, I would say that funder control is medium to high. And that is because generally with grants, you're given grant funding to go and complete a project, and you have to say upfront what that project is, and then deliver on it. So with the spend of the grant, it's very tightly controlled by the funder. However, once you've completed, once you've used up that money or finished the project that you initially pitched to them, they no longer have any control. So they have a high degree of control, but only for a short period of time. The next option is equity. So this is buying shares in someone's company. And obviously, if you're a charity, this is not an option. If you're a not-for-profit, this is not an option. And you basically have to be a company structure to take on charity. So this will not fit everyone, but this can also inform what structure you take on. Because if you think at some stage you'll need equity funding, then you need to be a company, basically. So the characteristics of this are people give you money, and in exchange, you're essentially giving them a piece of your business, because at this stage, if they're not interested in social outcomes, or if the social outcomes are a long way away from happening and there's a high risk, then they'll be looking for some kind of different kind of return. And in this case, it's profit participation. So traditionally, when you take on equity investment, you're offering for that person to participate in profits. This is subject to change by agreement between the parties, and all these kinds of funding that we'll look at can kind of merge into each other. But traditional equity is about profit participation. In terms of the risk that they're willing to take on, it's quite high. So you may have heard of angel investors, and they're the kind of investors that get involved with really early stage organizations that have quite unproven business models. So in the early days, this is really important growth capital if you want to be a high growth company. It may be that your problem is within one community and you have no desire to be a high growth company, and that is equally as valid. Amount. So generally, if you're raising equity investment, it can be as little as 10K. That tends to be more kind of friends and family investment. But it can get up to about 20 million. There are probably a smaller number, but there are definitely deals happening in New Zealand where people can raise 20 million from equity investors. And in terms of the funder control, I've also put this as medium to high. And this is because shareholders have a very high level control. Firstly, they need to have a majority of shareholding to make any decisions. And then the decisions that they can make are really high level stuff like why does the company exist and who can run it? But they don't have any control over the day-to-day operations. So the control in practice isn't huge, but this is ongoing forever. So unlike grant funding, it's not just for the spend. It's not just in relation to the money that they gave you. They're bought in forever, or at least until you can buy the shares back off them, or they sell it to someone else. So although in practice the control probably, maybe in the early days it will have more of an effect. But yeah, it is a forever relationship. So you have to be really careful about who you sell equity to, and alignment of what you're trying to achieve is really important in this case. The next one's debt. So this is your classic bank loan. The return in this situation is linked to the amount that's owed to the bank. So if, and it doesn't just have to be a bank, but I'll use that as an example. A bank may charge, so they'll charge interest. It'll be, 8% of the amount that's still owing to them. And because the repayments generally start immediately and the interest has to be paid almost immediately, their risk level is low. So you either have to already be self-sustaining and you're just trying to grow, or you have to have a contract lined up that will pay for the cost of your loan. So you have to be much closer to being sustainable before you can access debt funding. The amount really, as long as you can prove that you can pay it back by your cash flows or future contracts, you can access as much as you like. Banks will loan millions and millions of dollars to companies. And the funder control is really low because the transaction here is really based around money. And they're taking on very little risk. They don't get any say over your business or how it's run. So debt is obviously, because of this low control, and it's a reasonably cheap form of capital. It's really good for social organisations, but hard to access. You need to be quite established before you can access debt. And there's a lot of stuff going around about social loans, and this basically means that people are starting to take into account your social aims, and might be willing to take slightly more risk or give you a lower than market rate price for using the money, but keeping in mind that you'll still need to be a lot closer to being self-sustainable than for equity investment generally. So all the stuff we talked about earlier about having a plan and showing how you can execute on that plan is still really important when it comes to debt, even if it's social debt. And the last and best one for social enterprise is revenue. So remembering that our ultimate aim is to the largest extent possible, fund ourselves through revenue for the purpose of autonomy and sustainability. This is an area that should be focused on right from the beginning. So in this case, the return to the person who's giving you the money is the product or service. And the risk is low because there's just an immediate exchange, usually pretty immediate. The amount that you can take on depends on the success. So if you're getting income from revenue, it's also an indicator that your company is really successful. So yes, The amount that you can take on from revenue purely depends on how successful you are at getting customers to buy your product or service. And the funder control is none, because it's the people that are buying your product or service. Apart from driving your business from a market point of view, they have no say over how your business is run. Again, unless you have some kind of democratic legal structure that allows them to have a say. So revenue is the ultimate aim, and right from the beginning, you should be focusing on how am I creating revenue? How can I be more successful in order to create more revenue? So the next issue is where do I start, and where can I find funding for my social enterprise? And because of the nature of social enterprise being more of a long-term focus, the usual place to start is self-funding. And this is the same for commercial businesses. Most startups, whether social enterprise or commercial, will start with an element of self-funding. So what you want to do is do this in a smart way. So almost think about when you're putting your time and money into your business, in the beginning, you want to do it strategically and make sure that you're not wasting your own time and money. So when is this a good time? Basically right from the beginning until you can access the next type of capital. So when I say we're doing this in a smart way, we want to think about what do I need to show, what do I need to prove to get to the next stage of capital, and how can I get there as quickly as possible? So really starting to think strategically about my plan to get to sustainability, and how can I take out risk in that early stage as quickly as possible. The next part is why. There are a lot of reasons why. One, because in the beginning, if you have no evidence or no plan, no one will fund you. That is your only option. And the second one, if you can do it really smartly and successfully, it one shows that you can back yourself, and two gives evidence that you execute on what you say you will. So if you set out a plan and say, okay, I'm going to self-fund myself this much or provide this much of my time and this is what I'm going to achieve, and then you achieve that, that's going to be a really powerful indication to funders and investors that you can execute on what you say you will. And the how is what we've talked about. Think about it as investing someone else's money and do it in a strategic way. The next option is crowdfunding. So crowdfunding takes a lot of different forms. It can be gifting, which is similar to grant funding that we looked at earlier. It can be equity, so you can sell shares via crowdfunding, and it can be debt as well. So think of crowdfunding as a platform for accessing those different types of funding rather than a different type of funding in itself. But for early stage social enterprises, it can be a really handy way of getting funding, because if you can't access grant funding from charitable organizations, this is a really great alternative. So the first is, what are you looking for? In the early stages, you're probably looking for gifting rather than investment. You have, like I said, even with crowdfunding, you have to have quite a high standard of evidence of a plan in order to access that funding. So starting off with a clear ask, how much money do you need and what will you achieve with this? And that could even be sorting out my business model. But always clarity is really important. When, use this when you have a crowd. So crowdfunding doesn't mean that you go onto the internet and there's this automatic crowd there waiting to give you money. It's just a mechanism. So you really need to bring your own crowd. So it's useful when you're starting to get a lot of buy-in to what you're doing. But also if it's a kind of community-based project, then the whole community can start contributing to it. And the other point to make there is that if your community is funding it, it's a really powerful way of showing community buy-in, which then can be a really powerful piece of evidence to take to grant funders or investors, whoever the next chunk of money is coming from. Why? They will invest because they want you to succeed. If it's gifting, it's at this stage, it's about believing in your cause. And how? The same as before, do it strategically, and deliver on what you promised to the crowd. So make sure you're clear about what the money will help you achieve, and then you can report that back to your crowd and show that their money has achieved something, and that can also, you might want to go to them for another chunk of money. I'm not sure how likely they will be willing to give it twice, but they'll be more likely to give it twice if you show that you've achieved what you said you would. And it can also be really great evidence to take to the next funder. Foundations. So this is where, between this and government, this is where most funding comes from for social interventions. There are really large chunks of money, but as I described earlier, they have their own agenda of the impact that they're trying to create. So they tend to grant in quite specific ways and for a specific reason. And I think understanding how foundations operate and why they exist is really important in terms of figuring out how to approach them, or if to approach them. So the first thing to consider is, what do they fund? They tend to fund projects. They're much more likely to fund a project that is, for example, going into schools and educating kids on something that will have a long-term impact, rather than building a business that in the long term will create sustainable impact. That's because of one, it's less risk for them to be directly connected to the social outcomes that they're trying to create. And because of the amount that they have to give, often for them, and investing in projects is the best way for them to create maximum impact. So when should you apply to funders? One, when you're aligned with the impact that they're trying to make, but also there's a very specific time that you can apply, and each foundation has their own funding cycle. Some of them you can just apply at any time, but largely they'll have a specific time of year that you can make an application. And you have to fall in line with the way that they do things, because they do that for a specific reason. That's how they create their impact. And so you have to find some alignment with them if you want to access their funding. Why should you go to them? Only if your impact is aligned. So if you just really need money and you're going to them and you say that you'll deliver on something because you need the money, that's distracting you from your plan to get to sustainability. So if you can align with them in the sense of, I'm going to run this project, and it could be like a pilot, for example, and this pilot will create this impact, but it will also create some kind of evidence that that there is customer buy-in, or that there is beneficiary buy-in, and that it makes a difference in their lives, then it's also a really important tool to getting you closer to sustainability, or getting you closer to the next chunk of funding. So this can be really powerful, but a bit of thought has to go into how it can best be used. How is it used? So as I said earlier, you make an application, and you have to adhere to the application. So think very carefully about the project that you are pitching, and how that is going to get you closer to your end goal. This is how traditional foundations work, and there are some organizations that are that are really recognizing how social enterprises work and just seeing this as kind of early stage R&D, research and development, or early stage seed capital. So this isn't an absolute, but this is just trying to build awareness of the traditional foundations and how approaching them can best serve you when you're looking for funding. And there are different types of foundations as well. So the first one is like the private or family foundation set up by a wealthy family, or just some kind of private entity. And these foundations have the most flexibility. So these are things like the Tyndall Foundation, I think the J.R. Mackenzie Trust, the Todd Foundation. They get to decide what causes they support and how they support them. Community trusts are huge in New Zealand. This is quite unique to New Zealand, but with community trusts, they're actually governed by legislation. They were set up by government, and they are set up to build prosperity within a certain community. So if you have a project that's nationwide or not within the remit of that specific community trust, then you should not be applying to them for funding. That's the major limiting factor there. But again, if you could run some kind of pilot within that community on a project basis, that could be useful. And then the last one are corporate foundations. So these are things like the Vodafone Foundation, the Spark Foundation, and these are similar to private or family foundations because they they are set up by an individual who gets to decide what kind of impact they're making and how they achieve that. But keeping in mind that they, like all of the foundations, they have when they set themselves up, they got to choose, but they have a really clear idea of the impact that they're trying to make. If you look at people like the Tyndall Foundation, they tend to be very broad. They're just about creating a better New Zealand, but some people have very specific impacts. So you have to do the research up front to see who's aligned with you before you make any kind of application. So I've included a link down there to Generosity New Zealand. And this is basically a database of all of the grant funding that you can access in New Zealand, whether it's for scholarships for individuals or grants for organisations. So this can be a really useful resource to find aligned funders. It does cost some money to go on. However, I know you'd have to look into it, but I know that often the DIA, if you go into a DIA office or a library and on Marais, they will give you free access to that. So worth doing a little bit of research as to whether a library or DIA in your area can help you out, just to do a search and find aligned funders. So in terms of approaching funders, it's not just about finding aligned funders, although that is absolutely key. You want to build evidence, and part of building that evidence is by building a relationship with them. So find people early. Don't approach people for the first time when you absolutely need the money. So start to talk to them. Get feedback from them. So give them some ideas about your organisation, and they'll give you feedback about which parts of that are of interest to them, or if they are very aligned and they have experience in this area, they might give you some ideas about how to improve your idea. So you want to demonstrate coachability, and that's really important generally within business or within social enterprise, or even charitable social interventions. People should recognise that they cannot be experts in every area of the business. And so coachability shows that you are able to seek help from outside advisors and experts and take that on board and channel it into your organisation. And that's one of the most powerful skills that a leader needs to have. And then demonstrate your ability to deliver. So if you go to them early, you seek their feedback, you take on board what they say, and you go away and you deliver. This might be during your period of self-funding. And then when you come back to actually apply for or ask for investment, they know you and they've seen your ability to achieve what you say you will. And that just makes it infinitely more likely that you'll be successful. When you go and talk to them initially, I've already talked about feedback. In any kind of funding, you may not get all of the funding from one person. And if that's the case, then you want to look for leadership. It's always, in any type of funding, the hardest thing to do is to get that first funder through the door. And then once you've done that, people follow much more easily. And then you want to ask for contacts as well. So if you go and talk to someone and they say, well, you're not quite the right fit for us, or we might give you the funding, but we wouldn't fund the whole thing, then you should be asking them, who else should I talk to? Because these people are, like, whether it's an investment or in philanthropy, they're all very connected. They all know each other and they will have contacts to give you. So in terms of the funding, we always want to ask these tough love questions. And the first one is, do you have a social enterprise? Or do you intend to have a social enterprise? You don't have to have it all figured out right now, but a really clear understanding of what it means to be a social enterprise for yourselves and for your funders is something that all people should take some time to think about. I've worked with a number of organizations that decided in the end that social enterprise wasn't for them, and they went down the not-for-profit route, and they've been doing some incredible stuff. So it's a question that you should ask yourself, and there is no right or better answer. Do you understand your financial needs? And yeah, you don't have to have a spreadsheet that figures every little detail out, but you should have some really high-level stuff, and have some value milestones. So when you're going along and you're thinking, oh, well, this chunk of money might help me get this amount of customers on board, and that proves out your business model a little bit more and proves out your ability to execute a little bit more. Having a clear idea of different things that can indicate your success gives you a really good direction for how you can work towards sustainability. Are you being smart about where and why you are seeking money? So in terms of social enterprise, it's not about funding your operations, which is generally what grant funding is about. It's about projects, and you go and you say, I need money for this, this, and this, and I will go and do this, this, and this. It's about those value milestones. If I take on this money, what will I use it to go and prove? What value milestones will I hit? And how does that get me closer to my end goal? That's what you need to be thinking about. And finally, would you fund yourself? I mean, if you're working on a social enterprise, you definitely would, but at arm's length, is this something that you have a real belief in? Is it something that you would be willing to put your own money into if someone else was doing it? Is generally a pretty good measure, if you're really being honest, of where you're at. And if the answer is no, that means you need to keep self-funding, but you need to keep making a plan. And you might even need to get some other people on board with different skills to complement your own. Before I hit these key points, we talked a little bit about, at the beginning, people said they wanted to know which funders were supportive of social enterprise. So first of all, because there are a lot of charitable foundations out there that can't give to people that distribute profits. A social enterprise, of course, can be a charity. A charity can have trading activities that sustains it, and that makes it a lot easier to get the funding from foundations, but should not be entered into without thinking about your long-term needs. Because if you can grant fund yourself to sustainability, that's fine. If you can't, you need to know that pretty early on, because taking on charitable status might limit the kind of investment you can take later. So it's all very strategic. And that's why people like Ākina and other organisations exist, because people need support in doing this, because it is hard. So there's the self-funding option, there's friends and family, there's crowdfunding, and if you are going to foundations, organisations that I know of that maybe not all the time, but have shown a willingness to support social enterprise, the Tyndall Foundation, I think J.R. Mackenzie Trust, some community trusts, they can't give to organisations that distribute any profits, but they will do social loans, so give you a loan on really friendly terms. I know the Rata Foundation in Christchurch has done some really awesome stuff supporting social enterprise. So it can be harder because it's unfamiliar to people, but there are a number of organisations out there that will consider supporting social enterprise as long as they're really clear on the impact that they're trying to create. But yeah, go on to Generosity New Zealand and have a look around and figure out, what's aligned with you, and just start talking to people. That's the best way to start building relationships, start building profile, and getting to know what's out there in the sector. So the key points are, it's a commercial mindset. It's not about taking on money to pay for your operation so that you can keep doing what you're doing. It's about taking on money to get you closer to sustainability. So it's a different mindset. It's subtle, but really important. So your approach to capital raising should be strategic. And in saying that, I don't mean you need to know every step of the way, but at least with this round of funding and maybe even the next round, you need to think about what are the value milestones, what is this chunk of money achieving, and how is it getting me closer? And then early stage funding is about building evidence, i.e. hitting value milestones, or going out and doing surveys, just demonstrating evidence that there is customer buy-in, that you can execute, that you're better than the competition, or there is no competition, stuff like that. And also building relationships, because what you put down on paper is just one form of evidence, and it's nowhere near as powerful as people knowing you and seeing your ability to execute on things. So these are some useful links. There's one to Generosity New Zealand. Simmons Stewart have some legal templates. This is more for people that are looking at investment, but could be relevant if you're doing some really early friends and family investment and just want to whip up a cheap template. So you can check out their website. Impact Terms is the other one. Again, more for later stage investment, so it might be less relevant, but there's some really interesting stuff on there about different ways to protect your mission or balance mission with your need to raise funding and focus on your sustainability. So worth checking out, even if it's not right for you right now. And that is the end. So hopefully that has been useful and given you some stuff to think about. I will hang around for another few minutes if you want to put any questions into the chat. Otherwise, you can feel free to flick me an email, and happy to answer some questions, or point you in the direction of some support, either with or without Ākina. And look forward to seeing all of your progress.